Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT and the latest economic data. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. I took a couple of days off extra just because, my throat was in no position to make videos, but hopefully now it's better. My voice is probably not back to what it used to be, but close. All right. So the biggest event, the main event of really this week was the Nonfarm Payroll report. All right. And we discussed this many times, how important this was going to be. In the meantime, we also got, the Fed Beige Book. I was planning to make a long video on the Fed Beige Book. Didn't manage to make it. We'll be getting another Beige Book in a month's time, if I'm not mistaken. So I'll be making a video on that. We also got initial jobless claims, which is worthwhile going over at the same time. And really, what you continue to see is basically, my base case, all right? And that is a slow grind higher in the initial jobless claims, all right? So you have a bottom in January, like last year, a bottom in January, and a slow grind higher moving it towards summer. Now, granted, this is a significant spike to the upside in 247. I would not be surprised if we have just a little bit of reprieve in next week's number, meaning anywhere between 230 and 240. Initial jobless claims like to spike up, and then they come back down before moving up again. If you look at last year, for example, we had several instances of that. The week of March 25th, we went to 223, and then we went back down to 209. We spiked up to 229, and we came back to 216. You get the picture. So don't be surprised if next week you get anywhere between 230 and 240. Same thing for continuing claims, all right? Continuing claims continue to march up. Granted, we did see, some stabilization right here. But again, if you ask me at least, if you ask this schmucks with a YouTube video's opinion, the direction of travel is up for continuing jobless claims. And again, it could also end up being quite a conservative figure. But again, I wouldn't be surprised if we see anywhere between 2 and 2.1 million on continuing claims in the months ahead. But who am I kidding? This video is about non-farm payrolls. So non-farm payrolls came out at 139, slightly above consensus. I was following it on Bloomberg. Bloomberg had the survey of 125K, if I'm not mistaken. The unemployment rate stayed steady at 4.2. Now, there are a couple of things that you can say about this report. And I want to start off by something that I highlighted prior to the release. First off, ADP, all right? This just goes to show you how little relation there is between the two. ADP came in at 37K, all right? This is just another demonstration of how you really shouldn't put too much, weight on ADP, because it usually has little to nothing, in relation with the non-farm payroll report that comes out on the following Friday, all right? Second, which is something else I mentioned in the lead up, is the revisions. All right, March got revised down to 120K. If you recall, the original number that got printed in the first month of April was 228. We are down to 120. April's payrolls got revised down to 147 from 177. Now, you might ask, why do we continue to see this? Because this is something else that we've, this has been a feature of the Biden administration as well, all right? Biden administration, we see like January of 2024, 400K was a ridiculous number, or 300K, and it got slashed down to 100K. I mean, what's going on? Well, a lot of it can be attributed to, the birth-death model. And if you want to learn more about that, follow Danielle DiMartino Booth. She's probably one of the best, more knowledgeable on the flaws of the birth-death model. But a more simple explanation is this right here. One of the reasons why we continue to see these huge revisions to the downside is simply because the response rate on these surveys, on the establishment survey, the first round, which you see right here in red, is very, very low. The second and third round of response rate is quite higher. So of course, if you have more people answering the survey, it's going to be more accurate. All right. And what happens usually is that when the economy is expanding, these revisions are to the upside. So on the uptrend, when the economy is booming, these surveys tend to underestimate the strength of the economy. And so they revise those numbers up. On the downtrend, when the economy is slowing, not in a depression, again, when the economy is slowing, you get the opposite effect. These surveys tend to overestimate the strength of the economy. And so revisions tend to be to the downside. All right. Now, all of this, why am I telling you all of this? All right, this isn't a cope channel. All right. I'm just telling you this so that you know that this number, 139, by the time even, we get to next month, probably won't be 139. Now, who knows? This might be one of those times when we get revisions to the upside. But given, recent history, don't be surprised if we're about, around 100K, right? Between 90 and, 110K on this month's report. So do keep that in mind. If you go and kind of peel back extra layers, you'll also see shenanigans going on in the household survey, where you saw a lot of full-time employment go down. But again, this ain't a cope channel, so we have to go off of the numbers that we have. And the numbers that we have are basically 139 for the non-farm payrolls, and that's what the market is going to react to. So that's what you have to deal with, all right? Before I move on to TLT, quickly going over the unemployment rate. The unemployment rate stayed steady at 4.2. But again, if you just peel back the layer a little bit, we were a smidge away from going up to 4.3. On an unrounded basis, as Nick Timmerose puts it, the unemployment rate ticked up to 4.244% in May, up from 4.187% in April. And last time the unrounded print was this high was October of 2021 at 4.5%. All right, so do keep that in mind. If we continue to see, the reason why I was pointing initial jobless claims out before is because, again, if you continue to see initial jobless claims stay stubbornly above, the line in the sand, which I conveniently, imagined being above 220K on initial jobless claims, don't be surprised. It won't take much. What I'm trying to say is it won't take much to push the unemployment rate up to 4.3%, especially if we continue to hover above, even 240. The last time we got numbers that were, around this range right here was July of 2024. And in July of 2024, we saw a 0.2 increase in the unemployment rate. All right. Something else to consider, the labor force participation rate. I always warn for shenanigans. Boy, did we get shenanigans. So one of the reasons why I said we might get a 0.2% increase is that perhaps if we saw, like previous months, the labor force participation rate continue to move up, just even by 0.1%, that could artificially, quote unquote, move the unemployment rate higher. Simple reason is if the pool of people actively looking for a job goes up, and the economy isn't really that doing too hot, meaning that they can't find that job immediately, artificially it'll just push the unemployment rate higher, right? On the other hand, if people are quitting the labor force altogether because maybe they can't find a job, Yes, that can suppress the unemployment rate, but at the same time, it's suppressing it for the wrong reasons. It's, again, it's suppressing it for the wrong reasons, being if you're quitting, the labor force because you can't find a job, and so you're not going to look for a job actively anymore, that's not good news, all right? But this is, again, part of that perhaps coping, um, you know, uh, reasoning that that you can come up with. We'll know in months' time. By the time this is over, we'll know whether or not why we continue to see what we're seeing in the labor force participation rate. All right. Historically, just know that the trend is has flipped ever since 1999 and the early 2000s. We have been on the downtrend, and there are things to be said about this, in relation to perhaps even AI and what effects that could have on employment. But that's a topic for another video. So again, I was expecting 4.3, my base case on the unemployment rate. We got very, very close to that. All right, we got very, very close to that. On an unrounded basis, we're just 0.006 away from 4.3. So do keep that in mind. Overall, if my biased opinion is that this report was kind of all over the place. You had kind of everything going for it in terms of the the prints, the headline numbers. But again, if you go and kind of peel back, there are questions to be raised. All right, that is what I'm trying to say. Also considering the fact, mainly really, of that revisions have been to the downside, and 139 isn't that high to start off with. So even if we get somewhere in between, an average between -30 and -65, let's say -40, right? -40 would put us at 100K. And 100K isn't, it's basically July, July of 2024 levels, which of course we all know what that time of 2024 was. So again, keep all of this in mind. As far as TLT is concerned, well, this was kind of a mix of the three scenarios that I highlighted. Meaning it was a mix between scenario number one and scenario number two. An economy that is still okay, nothing gangbusters like anything above 165, still okay, anyway between 120 and 140. But at the same time, you have the unemployment rate holding steady. Now, you could make the argument that it's still number two, meaning run it hot. The only reason I won't make that argument is that we were very, very close to going up 0.1% on the unemployment rate. So again, it's kind of a hybrid between the two. Now, regardless, good news, relatively good news for the economy is not great, to say the least, for TLT. And what we saw yesterday was, again, a down day. All right. Nothing too dramatic. Again, we're still, a fair bit away from, the low put in May 22nd. But again, you're probably not going to see, TLT go above the bull market support band. Now, one caveat to that is that next week we have CPI. If CPI comes in somewhat softer, as it has been in the previous months, although consensus is for a rise in CPI, if you see continuation, the softness in CPI, that could absolutely be supportive of TLT. Although I think that at this point, what TLT would like to see is really bad non-farm payroll reports. All right. The unemployment rate going up, non-farm payrolls starting to disappoint, rather than inflation. I think that right now, I mean, TLT is probably prone to the worst of everything. All right, because I wouldn't be surprised if TLT doesn't really react in a outright positively on Wednesday when CPI comes out. If it comes out soft, but I wouldn't be surprised if it overreacts if we get even in line or slightly above on CPI. We're in a situation where TLT is again extremely sensitive to inflation numbers if they come to if they print to the upside, and if inflation comes in below expectations, or in the extremes, with the extreme softness that we've been seeing in the last couple of months, it doesn't really care. All right, because it keeps on pricing in, again, with the dollar, in my opinion, some kind of a stagflationary environment where the dollar is significantly lower compared to what was this, January's high, and yields are up. All right, so the dollar probably declining is pricing in lower U.S. growth potentially, but yields are pricing in that deflationary side of the stagflationary. All right, so keep that in mind. So don't be surprised if next week we don't get we get a frustrating reaction on the price action in TLT. Of course, we didn't get a good report on TLT, so again, going up to the bull market support bound is probably out of the question. What can be said is that, as has also happened in the past, again, TLT makes a trend line and then it breaks it. All right. If you go back to October of 2023, for example, we were in a downtrend ever since April of 2024, April and May of 2024. We didn't break out. Then we did. We backtested it once, we backtested it twice, and then we went off to the races. Potentially, you could make the same argument now, all right? Downtrend, breakout, backtest. Potentially, we go back and backtest, somewhere around 83, 83.50 to $84, something like that. Do keep that in mind. Overall, again, if you ask me, I'm still sympathetic to the idea that we kind of potentially even sweep the low. I'm prepared for that outcome. If it happens, it happens. Good. That for me will be a buying opportunity. Again, not financial advice, but that is generally how I would go about it, given everything we said about the economy. But if it doesn't, better. Just know that as long as you don't really have that, again, smoking gun moment, which again, I think will come, it will definitely come, but it will take time. All right. We were all, really the market was really prone and prepared for immediate falling off a cliff. Like the economy immediately falling off a cliff. And we also, because we continue kind of to flirt with this idea, because again, the ISM numbers came in, the services report came in weak, PMIs haven't been too hot, initial jobless claims continue to trend up, although slowly, but they continue to trend up. Continuing claims continue to trend up. So we continue to flirt with the idea that we're going to get some kind of a, bad print. But it never really comes. And the reason for that is that simply put, what this economic cycle has shown us is that if you're waiting for something like for that aha moment, you're usually not going to get it. It's going to happen, again, it's going to be a process, as I usually say. It's going to happen slowly. We're slowly going to get there. And then as everything usually goes, slowly and then suddenly. but don't expect that suddenly just yet, in my opinion. That's basically how I'm going about things. And as long as we're in that environment where things are slowly trending in the right direction, but nothing too dramatic, to me, that just leaves us in a position where we're prone, we're primed even for a sweep of the previous low we put in October of 2023, given also the fact that TLT likes to sweep the previous low, right? Like in 2006, 2008, 2003, 2004, and also 2002, 2003, all right? Do keep that in mind. So overall, this non-farm payroll report was definitely better than the base case, than the bear case, absolutely. But you kind of get the feeling that everything's kind of not on a knife's edge, but if you peel back the headline numbers and you just dig a little bit deeper, look at revisions, how they've been coming in, where about, if you consider January, February, March, and April, we're collectively down by about anywhere between 150K, 200K, 200,000 jobs. All right. That is significant because, again, that is also before the QCEW revisions. All right. We're going to get another release, another benchmark at the end of this month, if I'm not mistaken. So that'll be interesting to see as well. Overall, though, the headline number is what the price, the market reacts to. So that's what we have to consider. And given the fact that, this report was okay, nothing to see here really, TLT doesn't really have much of a reason to rally at this point. All right. What will tell us whether we get a secondary, test of this trend line right here, or even, further downside, is next week's inflation report. All right. And again, just to keep expectations in check, do not be surprised if good news on CPI does not equate to good news on TLT. Because again, that's what we've been seeing in the last few months. TLT doesn't care of good inflation, but if it's bad inflation, it goes gangbusters. All right, keep that in mind as well. I'll stop here. Hopefully you like this video, and I'll see you next time. Bye.